Stop making business so complicated. I want to show you something that changed how I think about running a business. This is our office gym. Nothing fancy. A few weights, a squat rack, a pull-up bar. That's it. When I go to a commercial gym, I have no idea what to do. There are 50 machines, 100 different exercises, and I end up doing nothing because I'm overwhelmed. But down here, it's simple. 3 exercises, show up, do the reps, get results. And that's exactly how the most profitable businesses I work with operate. Over the last 13 years, I've worked with hundreds of Australian business owners. The ones making real profit, the ones who actually have cash in the bank and time to go on holiday, they all do 3 things that most business owners completely ignore. And here's what shocked me. The businesses that struggle the most are the ones with the most complicated systems, the most entities, the most meetings, and the most spreadsheets. They think complexity equals sophistication, but it doesn't. It just equals more chaos. So today, I'm going to walk you through the 3 lessons that consistently separate profitable, simple businesses from complicated, stressful ones. You'll see exactly where complexity is costing you money, how to strip it back, and the simple structure that keeps more profit in your pocket without drowning you in admin. Let's get into it. Lesson 1, keep your structure simple. And when I say structure, I mean how money flows through your business and how you're set up from a tax perspective. This is where I see the most damage. Business owners get sold on complicated structures because they hear phrases like asset protection or tax optimization, and they assume that more entities equals tax saved. But here's the trap. Every entity you add creates extra complexity, extra admin, extra accounting fees, and extra risk of getting something wrong. Let me show you what simple looks like for most Australian service-based business owners doing between 1 and 5 million in revenue. You've got 2 companies. That's it. Company 1 is your trading company. This is where you operate the business, earn revenue, pay expenses, pay yourself a wage. At the end of the year, whatever profit is left gets taxed at 25% if you're under the small business threshold. Company 2 is your investment company. Sometimes we call this a bucket company. This is where you move profits from your trading company so you can invest outside of the business without taking the money personally and getting hit with 47% tax. So the profit sits in the investment company at 25% or sometimes 30% tax, and you use it to buy shares, property, or just build a cash buffer. That's the structure. 2 companies, 1 trades, 1 invests. Now, does everyone need this exact setup? No. If you're just starting out and doing under $200,000 a year in revenue, you probably don't need a company at all yet. But once you get profitable and reinvesting, this 2-company model works for the vast majority of Australian small business owners. Here's my rule. Don't add another entity unless it solves a specific problem and the numbers justify it. If someone's trying to sell you a discretionary trust, a unit trust, a holding company, and an SMSF all in 1 year, run. You don't need all that complexity. You need profit first and then structure second. Don't believe me? Let me show you what complexity actually costs. Say you're doing 2 million a year in revenue with 20% net profit. That's $400,000. If your structure is clean and simple, your annual accounting and compliance costs might be $15,000 to $20,000. But if you've got 4 entities, multiple trust distributions, loan agreements between companies, and unclear allocations, that cost can easily blow out to $40,000 or $50,000. That's an extra $25,000 every year just to manage the mess. And that's before we talk about the mistakes. Missed super deadlines, incorrect trust distributions, Division 7A loans that weren't documented properly. One client came to us with 3 entities they didn't need. We simplified it down to 2 and saved them $18,000 a year in fees and cut their tax prep time in half. That's what I mean by the complexity trap. Lesson number 2, have a simple plan and track your progress. Back to the gym. When you walk downstairs to our gym, there is a whiteboard on the wall. Every session, you write down what you lifted, and that's it. You're not tracking 47 different metrics. You're tracking the basics: reps, weight, and progress. And here's what happens. Just by tracking it, you naturally start improving it. It's the same in business. Most business owners I meet have no idea what their profit margin is. They don't know how many weeks of cash they have in the bank, and they don't know their debtor days. They're running blind. So here's what I recommend. Track 5 numbers. That's it. 1, revenue. What's coming in each month? 2, gross profit margin. Revenue minus direct costs. This tells you if your pricing is working. 3, net profit margin. What's left after all your expenses? This is what you get to keep. 4, cash in the bank. How many weeks of expenses can you cover with your cash? And 5, debtor days. How long does it take your customers to pay you? That's your scorecard. Now, once a quarter, you sit down and review those numbers with your accountant. Are they improving? Are they getting worse? Why? What's working? What's not working? And here's the thing. When you start measuring, you start managing. I've seen this play out hundreds of times. A business owner starts tracking their debtor days. They realize they're taking 60 days to get paid. So they tighten up their invoicing processes, send reminders earlier, and suddenly they're getting paid in 20 days. That's an extra $100,000 sitting in their bank account. Or they start tracking gross margin and realize one service line is barely profitable. So they either fix the pricing or just stop offering it altogether. Boom. Profit jumps by 10%. You can't fix what you don't measure. And the beautiful thing about keeping it simple is that you actually will do it. If I told you to track 30 KPIs, you'd give up in a week. But 5 numbers, that's manageable. Lesson number 3, discipline beats motivation. This is the boring one, but it's the most important because simple is boring. And that's exactly why it works. You know what happens at the gym downstairs? Same 3 exercises, same routine every week. It's not exciting. There's no variety, but that's the point. Progress doesn't come from doing something new every day. It comes from doing the same thing repeatedly. It's the same in business. The businesses that win aren't the ones chasing the latest hack or the newest strategy. They're the ones doing the boring work consistently. Here's what that looks like practically. Invoicing on time. Every week, same day. Paying super every pay run instead of waiting until the end of the quarter. Reviewing your 5 numbers every month, not just at tax time. And meeting with your team every week to keep everyone aligned. That's it. Boring reps. But here's the trap most business owners fall into: distraction. They hear about a new opportunity, a new market, a new product, and they think, maybe this is the thing that takes us to the next level. So they start building the second bridge before they finish the first one. And now they've got 2 half-built businesses instead of one strong one. I've been guilty of this too. Shiny object syndrome is real. The discipline is saying no to the distractions and focusing on what's already working. Simple, boring, and effective. Before we wrap up, let me warn you about the 3 biggest traps I see when business owners try to simplify. Trap number 1, oversimplifying your structure too early. If you're making $500,000 a year in profit and you're still a sole trader because you think it's simple, you're leaving tens of thousands of dollars on the table in tax. Simple doesn't mean avoiding structure. It means having the right structure for your stage. Trap number 2, not documenting your simple systems. I see business owners who say, we keep it simple, it's all in my head. That's not simple, that's a liability. If your 5 key processes aren't written down somewhere, you can't scale and you can't step back. Trap number 3 is chasing tax savings with complexity. This is the biggest one. Someone tells you that if you set up a family trust and a corporate beneficiary and distribute to your adult kids, you'll save $30,000 a year in tax. But now you've got 4 entities, unclear distributions, and you're one ATO audit away from a Section 100A problem. The tax you saved just became a $100,000 penalty. So my rule is if the tax strategy requires 3 entities and a 10-page explanation, it's not worth it. Keep it clean. Keep your structure simple. Track your progress with 5 numbers. Do the boring reps consistently. Now, if you've got your structure sorted and you're tracking your numbers, the next question becomes, what do you actually do with the profit you're making? Because keeping it in the business forever isn't a strategy. And taking it all out personally at 47% tax isn't smart either. So the next video you need to watch is this one, where I break down exactly how to move profit out of your business tax effectively and start building wealth outside of the business. But if you want us to sit down, review your structure and build you a simple 1-page scorecard so you can actually see where your business is going, book a call with us. The link's in the description. See you in the next one.